Good day, students. This is Belina Morake. Today, I'm going to do direct labor variances as we are busy with standard costing. So remember the labor variance. The total labor variance shows the impact of any overall change in the amount spent on labor. Remember, it can be split into two, whereby we're going to have the labor rate variance and the labor efficiency. With the labor rate variance, we are going to be comparing the difference between the budgeted rate that was paid to employees per hour with the actual rate that was paid to employees per hour that they are working. The difference between the rate will then be multiplied by the hours that they were actually in production. And then with the labor efficiency, we will then be comparing the hours that were actually used in the production against the hours that were supposed to be used in the production. And remember, at the end of the day, you have to state whether your variance is favorable or it is unfavorable. So we have from the illustrative example that we have been busy with at the beginning of the term. From that information, we are then going to be determining our labor rate, our labor efficiency, as well as the total labor variance. So remember, in order for you to calculate the variances, you need the formula. So the formula for the labor rate variance will be the standard rate minus actual rate multiplied by the actual time. That is the SR minus the AR multiplied by the AH. So the standard rate, remember, it is the rate that was budgeted to be paid by the company per hour that the employees are working. The actual rate will then be the amount that has been paid by the company for an hour that the employees are working. Remember, when you do standard costing or variance calculation, we always compare at the same level. So that is why we're comparing the 8 rand per hour with the 9 rand per hour. So they are at the same level. The AH will be the actual hours or the actual time that the employees were productive at work. So from illustrative example 11.1, the employees worked a total of 28,500. So then you can say 8 rand standard rate minus the 9 rand actual rate multiplied by the 28,500 hours, and that will give you a variance of 28,500, which is unfavorable or adverse. Remember, we have to explain why it is unfavorable, because we budgeted 8 rand, we spent 9 rand, so we've spent more than what we had budgeted for, and that makes our variance to be unfavorable. With the labor efficiency, it is the standard hours minus actual hours multiplied by the standard rate. So the standard hours, again, it will be the time that was supposed to be used based on the budgeted information to manufacture what was actually manufactured. The actual hours will then be the actual hours that we have spent in production, the SR standard rate. So according to the information, 9,000 units were manufactured. And according to the budgeted information, we needed 3 hours to manufacture a unit. So that is why we have the 9,000 multiplied by 3. So you can then say 9,000 multiplied by 3 minus the actual hours of 28,500. And that will give you a difference that will then multiply with the 8 rand to get your 12,000, which is your variance. The variance, again, it is unfavorable. Why is the variance unfavorable? Remember, if we have spent more than what we had budgeted for, it will be unfavorable. So 9,000 multiplied by 3 will then give you standard hours of 27,000 hours. So we budgeted to use 27,000 hours to manufacture, but we ended up spending 28,500, which is more than what we had budgeted for. And because of that, it makes our variance to be unfavorable or adverse. And then for the total labor variance, it will then be the standard cost minus the actual cost. So the standard cost will be the 9,000 that we budgeted that we actually produced, multiply by the rate for the labor that was budgeted, which is 24 rand. So when you say 9,000, multiply by 24 rand, you will then get your standard cost, which is 216,000, minus the actual cost of labor, which is 256,500. The difference will give us 40,500, which is unfavorable. Why it is unfavorable? Again, we budgeted 216, we've spent 256,500, which is more than what we had budgeted for. So because of this, it means we can run out of money. So that is how we go about with the labor calculation, the labor rate and the labor efficiency. But guys, remember, we also have what is called an idle time. We also have what is called an idle time. So you'll remember when you did your chapter 4 that idle time, it is the time that your employees are present at work, but because of whatever the reason might be, they are not being productive. The idle time, it is the time when employees are at work, but for whatever reason, they are not being productive. So because of that not being productive, we then get what is called an idle time. So we are going to also look into a situation whereby now we have to look at the idle time. So the idle time, the difference whereby you are at work but you cannot be productive. And then for us to calculate the idle time, we are going to focus on illustrative example 11.2. The question says the following standard have been set for labor. The labor rate is 18 rand per clock cut. The required labor hours per unit is 0.08 hours per hour per unit. Idle time provision is 20% of clock hours. That is the standard information. The actual results were as follows. Labor cost, 14,960 was spent for 880 hours that were working. Actual output, 10,000 units. Productive hours were 15% less than the hours clocked during the month. And then required is to calculate all relevant labor variances and provide the reasons for these variances. So the labor rate, remember the formula will be the standard rate minus the actual rate multiplied by the actual hours worked. So the standard rate, again, remember we get it from the budgeted information. So from the information, we know that we budgeted to spend or to pay 18 rand per hour that the employees are at work. So that is where the 18 rand is coming from. The actual rate, we need to calculate it because in this question, we have been given the total labor cost and the hours. So how are we going to calculate that? We'll take the labor cost of 14,960 and divide it by 880 hours. Multiply by the actual hours worked, which is 880. So 14,960 divided by 880 will then give you a rate of 17 rand. So we can then say standard rate of 18 rand minus actual rate of 17 rand multiplied by the actual hours of 880. That will give us a variance of 880. The variance is favorable. Why? Again, we have budgeted 18 rand, we have spent 17 rand. So because we have spent less than what we had budgeted for, that makes our variance to be favorable. And then continuing, we're now going to be working out the idle time. The idle time, the formula says actual productive hours minus standard hours multiplied by the standard hours rate. So for the actual hours, we've we've actually worked 880 hours. Idle time on the actually was 15%. So we'll then say 880 hours minus the 15% that the employees were idling. So that means productive hours actually were only 748. And then for the standard hours, we'll still use the 880 because remember we are comparing at the same level. So it will still be the 880 hours, but according to the budgeted information, we have planned that 20% of the time the employees will be idling. So we'll then say 880 minus the 20%. So according to the budgeted information, the employees were supposed to be productive for only 704 hours. Multiply by the rate. The rate we are paying our employees 18 rand, but remember we are making an exception for the idle time. The idle time, which is the 20%. So you will then say 1 minus 20% and then 18 divided by your answer, which will then give you 22 rand 50. So you can then say 780 minus 704 multiplied by the 22 rand 50 will give you a difference of 990. The variance, again, it is favorable. Why is it favorable? We actually spent 748 being productive when we're only supposed to be productive for 704. So more hours were used being productive as compared to the budgeted information. And then we also have to calculate our labor efficiency. The formula will be the standard quantity of labor hours for actual production minus actual labor hours multiplied by the standard productive hour rate. So guys, be aware, when there is idle time, this is how we calculate our labor efficiency. When we do not have any idle time information in the question, then we'll calculate it as we did in example 11.1, which I have just done previously. So if the idle time, we'll then say 0.08. Where do we get that again? That is the time according to the standard information to manufacture a unit. Take into account that 20% is for idling. So when you work out the hours taking into account the idle time, production you only need, as per the standard, 0.064 to manufacture a unit. Multiply by the actual units produced, which is 10,000, you will then get 640 hours, which is your standard or budgeted hours. Based on the actual hours, we manufactured, we used 880 hours, less 15% of the idle time. It means you could be productive for 748. And then the rate, again, we took into account the idle time of the 20%. So we'll then say 640 hours minus 748 hours multiplied by 22 rand 50. It will give us a variance of 2,430. The variance is unfavorable or adverse. Why? Because as per the budgeted information, taking into account the idle time, we only budgeted for 640 hours when we actually worked 748 hours. So remember, this is labor. We need to budget and pay the employees for such hours. So having budgeted for 640 hours and having to pay for 748 hours, it means our budget was not done accurately. So we have used more hours than what we were supposed to use as per the budgeted information. So because of that, it makes our variance to be unfavorable. And this is where we'll be ending the labor calculations. Thank you very much. Enjoy.